What happens if a giant brokerage like Schwab, Fidelity, or Vanguard actually fails? I know why that question hits people so hard, because the names feel permanent. They feel like infrastructure. They feel too large, too familiar, too woven into ordinary American investing life to ever be seriously threatened. And then reality reminds people that large institutions do fail. Silicon Valley Bank failed. Signature Bank failed. Lehman failed. Bear Stearns collapsed into a rescue. MF Global went under. So the average investor starts asking the only sensible question left. If my brokerage fails, do I lose my money? The short answer is not the one people expect. If what you own inside the brokerage is actual securities held in a normal brokerage account, then the firm's failure is not supposed to make those securities disappear the way a bank failure can put uninsured deposits at risk. That distinction matters. It matters so much, in fact, that most of the panic people feel around this subject comes from mixing up two very different systems, the banking system and the brokerage custody system. If you do not separate those in your mind, you will not understand what you actually own, what the firm owns, what the insurance does, and what the real risks really are. That is what I want to fix. Let us begin with ownership, because people always start there. Schwab is a publicly traded corporation. That means it has stockholders. Fidelity is different. Fidelity says plainly that it has been privately held since its founding in 1946. Vanguard is different again. Vanguard says it is owned by its member funds, which in turn are owned by fund shareholders. In other words, the firms do not all have the same ownership structure. But that fact by itself does not decide whether client assets survive a brokerage failure. That is the first thing I want you to relax about. The client asset question is not mainly an ownership structure question. It is a custody and legal segregation question. So let us go there. When you put money into a bank deposit account, you are not storing bills in a personal vault drawer. Legally and economically, the bank owns the deposit and owes you a claim. That is why FDIC insurance exists. FDIC says it covers up to $250,000 per depositor, per FDIC insured bank, for each ownership category. It also explains that different ownership categories can each qualify for separate coverage. That is why an individual account and a qualifying IRA or certain joint accounts can be insured separately. That is how bank protection works. You give the bank money. The bank owes it back to you. Insurance stands behind certain limits if the bank fails. Anything above those insured limits may become a receivership problem. That is the bank world. A brokerage account is supposed to be different. If you own stocks, bonds, ETFs, or mutual funds in a brokerage account, the brokerage is generally acting as custodian, not owner. SEC Rule 15c3. 3. The Customer Protection Rule requires broker-dealers to safeguard customer funds and securities, and, with limited exceptions, to maintain physical possession or control of fully paid and excess margin customer securities. FINRA's own guidance says essentially the same thing, broker. Dealers must establish possession or control of customers' fully paid and excess margin securities. In plainer English, customer assets are meant to be kept separate from the firm's own assets. That is the second thing I want you to understand. A brokerage failure is not supposed to turn your 100 shares of an ETF into corporate property that can be grabbed by the firm's creditors. That is the core legal protection. If the system works the way it is designed to work, your securities are segregated from the brokerage firm's own balance sheet and can be transferred to another firm or returned to you. This is why the comparison to a bank is so often misleading. At a bank, you are an unsecured depositor with insurance up to certain limits. At a brokerage, you are supposed to remain the beneficial owner of the securities being held for your account. That is a very different structure. Now, does that mean there is zero risk? Of course not. Zero risk is a phrase for salesmen and children. The real question is what kind of risk remains, and here is the answer. The main brokerage failure risk is not ordinary market loss. The main brokerage failure risk is that something has gone wrong with custody, record keeping, fraud, theft, or shortfall of customer assets. That is where SIPC enters the story. SIPC says it protects customers of failed SIPC member brokerages when cash and securities are missing, up to $500,000, including up to $250,000 for cash. It also says very clearly what it does not do. SPT does not protect you from market losses. It does not protect you because an investment went down. It does not protect against bad advice or the normal decline in value of securities. This is one of the most important distinctions in the whole discussion. If Schwab, Fidelity, or Vanguard fails as a business entity, but your securities are properly segregated and accounted for, the normal expectation is that the securities themselves are not gone. They should be transferred or returned. If there is a shortfall because customer assets are missing, that is when SIPC may have to step in. That is why I dislike the lazy phrase SIPC insurance, when people use it as if it were exactly like FDIC. It is not. It is closer to a backstop for missing securities and cash in a failed brokerage liquidation. Not a guarantee against investing losses or a promise that every product inside a brokerage ecosystem is covered. That nuance matters. Now let us slow down and talk about the coverage mechanics, because this is where people get tripped up. SIPC coverage is not just one flat $500,000 if you happen to have many properly distinct accounts. It applies by separate capacity. Schwab's own educational materials explain that separate capacities can include things like individual accounts, joint accounts, traditional retirement accounts, Roth retirement accounts, trust accounts, corporate accounts, and custodial accounts. Fidelity's own SIPC explanation also says protection is per account with separate capacity held at a SIPC member firm. That means an individual brokerage account, an IRA, and a joint account are not all automatically treated as one bucket. That matters for serious households. But again, I do not want you to misunderstand what this means. This does not mean you should race around opening random extra accounts and assume you have solved all risk. It means the protection structure is more detailed than one simple number, and people who understand the detail tend to sleep better. Now, another thing the source material was directionally right about is that large firms often carry excess protection above SIPC. Schwab says it has excess SIPC coverage through Lloyd S of London, with a total aggregate of $600 million across all Schwab brokerage clients and certain per-customer sublimits. If SIPC limits are exhausted, Fidelity says it carries total aggregate excess of SIPC coverage of $1 billion with no per-customer dollar limit on securities and a $1.9 million per customer cash, awaiting investment limit. Vanguard also says it carries additional coverage, although it is less explicit in public materials about the exact amount. Now here is the mature way to think about that. Excess coverage is comforting. It is not the main foundation. The main foundation is still segregation, custody rules, and the basic structure that customer securities are not supposed to become house assets of the failed broker. If you start mentally relying on excess insurance first, you are thinking backward. Insurance is what you want behind the structure, not instead of the structure. Now, I want to talk about fund structures themselves, because this matters especially at Vanguard and Fidelity and Schwab, where people often hold proprietary funds. A Schwab ETF, a Fidelity mutual fund, or a Vanguard fund is not simply the brokerage firm's own balance sheet asset in the way people sometimes imagine. Funds are separate legal entities with their own assets and liabilities. That does not mean there are no operational dependencies or service provider relationships. It means that if the parent brokerage company itself has problems, that is not the same thing as saying the fund's portfolio assets evaporate into the parent company's bankruptcy estate. That is an important psychological correction. People hear Vanguard fails and imagine all Vanguard funds instantly vaporizing. That is not how legal entity separation is supposed to work. Now, let me say something uncomfortable because it is the only honest way to speak about this. Brokerages are not riskless. They are simply risky in different ways than banks. A bank can fail because of bad loans or interest rate mismatch and leave uninsured depositors exposed above insurance limits. A brokerage can fail operationally, financially, or through misconduct and create a shortfall problem if customer assets are not where they are supposed to be. Those are different failure modes. And if you treat them as interchangeable, you will misunderstand the protections. This is why I tell people the most important question is not, can a brokerage fail? Of course it can. The right question is, what exactly do I hold there? How is it titled? What part is securities? What part is cash, and which protection regime applies to which part? That is the adult question. Now, cash inside a brokerage account is where things get especially confusing. Sometimes cash in a brokerage is literally uninvested cash awaiting investment, and subject to the lower SIPC cash sublimit. Sometimes the cash default is actually a money market mutual fund, and Fidelity points out that money market funds held in a brokerage account are considered a security by SIPC, not merely cash. That distinction can matter for how people think about the $250,000 cash sublimit. That is why I do not like one-size-fits-all panic answers. The exact nature of the position matters. Uninvested sweep cash is not exactly the same thing as a money market fund position. A Treasury ETF is not the same thing as cash. A proprietary mutual fund is not the same thing as the firm S corporate cash. You need to know what you actually own. Now let us talk about what SIPC does not cover, because this is where overconfidence grows. SIPC does not protect losses because your ETF fell. It does not protect losses because your stock selection was awful. It does not protect against bad advice being economically wrong. And it does not cover every financial product people lazily think of as something I bought at my broker. SIPC itself says it protects most types of securities such as stocks, bonds, and mutual funds, but not market decline and not certain non-SEC registered investment contracts. The safer principle is simple. Do not assume every product sold through or adjacent to a brokerage carries standard SIPC protection in the same way common securities do. Check the product type and the account agreement. That is a much better habit than memorizing half-correct lists from the internet. Now let me come back to regulation, because the source was right to stress that there are multiple layers here. The SEC oversees broker, dealers, and fund structures. FINRA conducts exams, licenses, and enforces conduct rules. The Customer Protection Rule and related financial responsibility rules exist to keep customer property distinct and controlled. Independent audits and reporting obligations create more layers of verification. Again, none of that means perfection. It means the system is designed with several barriers between a brokerage firm, S corporate trouble, and your client assets. And when people ask me, so are my assets safe at a major firm? My honest answer is this. They are about as safe as the U.S. brokerage custody system is designed to make them. But only if you understand what you are holding, and only if you stop mixing up bank risk language with brokerage risk language. That is the real conclusion. Not zero risk. Not don't worry about anything. Just clarity. Now let us make this practical. If you hold broad ordinary securities like stocks, ETFs, or mutual funds at a major broker, the failure of the brokerage firm is not supposed to make those positions disappear into the firm's debts. The legal structure and custody rules are designed to prevent that. If customer assets are missing because of fraud, theft, or serious mishandling, SIPC is there as a backstop up to its limits. And the big firms also advertise excess protection above that. If you are above SIPC cash limits in a brokerage, understand what is actually sitting there as cash and what might instead be a money market security. If you are above FDIC limits in bank accounts, understand ownership categories and how deposit insurance actually works, rather than assuming bank equals safe forever. And if you want the cleanest sleep possible, diversify operational risk where practical. You do not need to scatter every account across 5 institutions in a panic. But there is nothing irrational about having more than one financial rail in your life if the balances are large enough to justify it. That is not fear. That is design. And design is the whole point. So let me give you the cleanest possible answer. If Schwab, Fidelity, or Vanguard collapses as a firm, the first expectation is not that your stocks, ETFs, and mutual funds vanish. Those assets are supposed to be segregated, remain yours, and be transferred or returned. The real risks are narrower than people fear, but not imaginary operational failure. Missing assets, cash limit misunderstandings, product type confusion, and normal market losses that no insurance will rescue you from. That is the adult version of the story. And once you understand it, the question stops being a source of vague panic. It becomes a checklist. What do I own? How is it held? What part is securities? What part is cash? What is FDIC? What is SIPC? What is simply market risk? That is how grown investors think. Not with slogans, with structure. And structure, more than anything else, is what stands between a frightening headline and a survivable outcome.